Welcome. My name is Mike Walsh, and I have the honor of serving as the chair of the Charles and Anita Manoli Scholarship Committee. And on their behalf, I want to welcome you all tonight to the 4th annual Manoli Lecture. And I would like to begin tonight by taking a moment to recognize someone that we know very well on this campus, someone that we love, and the namesake of the Charles and Anita Manoli Scholarship. Let's welcome Anita Manoli. We are thankful that you have joined us as we welcome back to campus Dr. Donald Mullineaux, a graduate of the class of 1967, and the DuPont Chair of Banking and Financial Services at the University of Kentucky. And he will be introduced in a minute, but I wanted to just talk for a moment because we are mindful that since we met at this time last year, Jim Bombach, the founding chair of this scholarship, passed away last November, and of course in August we said goodbye to Professor Charles Manoli after 89 impactful and meaningful years. And so it's fitting tonight that we gather in the name of Charles and Anita Manoli to hear from a former student of Chuck's who went on to achieve great things. And it's fitting because this liberal arts college provides all of us, students, faculty, and friends, with the chance to expand our horizons, to listen, to learn, to inquire, and to engage in public discourse. And that's really what the Manoli Lecture is about. And if you knew Chuck Manoli, that's a good reflection of him as well. And so there are some students tonight, I imagine, who maybe never had the opportunity to meet Chuck Manoli. So I just wanted to talk for a minute about him. So if I can direct my comments to those of you who are currently enrolled here, think about one of your favorite professors. And think about this person and your admiration for him in this case, because he challenges you to think deeply, to inquire about answers that you might be seeking. And he's a professor who is known for wanting you to read things. He's always asking you, what are you reading? And when you go to his office and you sit down in the chair and you find yourself talking to him, you might realize that an hour has passed, and as you get ready to walk out the door, he hands you a book and says, read this, you might find it interesting. He's a history professor, and he's not interested in you learning the dates of history. He's more interested in you learning the lessons of history, and that's, I think, a big difference. And what I found most interesting about Professor Manoli is that students from every generation felt a strong connection to him. This professor had been around for a while, 47 years of teaching here at St. Vincent. He went here to the prep school, he went here to the college, he was married here, he raised his children here, some of them went to school here, and as I mentioned, every generation felt a connection to him. Every generation of students knew that when there was an issue that needed to be addressed, an unfairness and injustice, that Mr. Manoli would be there on the front lines. It was the case in the 60s when students wanted to protest the Vietnam War. They found Chuck Manoli marching alongside of them. It was the case in the 90s when I was here and we were having discussions about the kinds of speakers to have on campus, and he was right there pushing to ensure that there would be diverse thoughts represented on campus. So you knew of his love and devotion, and when you graduated, it didn't end. His wife and he opened their home to you, and you think that might be probably true on every college campus. I don't think it is. It's probably something special about St. Vincent. But the friendship you had with this favorite professor continued long after you left the college. And if that wasn't all enough, in his final years of teaching, he decided that he would donate back the money that he was earning for a scholarship committee so that more of you can benefit from a St. Vincent education. And to me, that's very powerful. So that was Professor Charles Manoli. And we also remember today one of his students, Jim Bombach. Jim was in his first classes in the 1960s. He graduated in 1965. He went on to law school, became well known throughout Pennsylvania as a successful attorney and a brilliant campaign strategist. And about 5 or 6 years ago, Jim learned that the Charles and Anita Manoli Scholarship Committee existed. He hadn't heard of it before, and he had strong admiration and a lifelong friendship with Chuck and Anita, and he wanted to help increase that scholarship in size. And that is when Jim recruited me and several others, and there were students representative of every decade that Chuck taught here, and he also decided that, well, we should have a lecture, and so this lecture series was created. And at homecoming last year, during his 50th reunion, and just a few short weeks before he passed away, Jim Bombach was named an alumnus of distinction at St. Vincent College. So tonight we remember them both. We remember Chuck Manoli, we remember Jim Bombach, and we want to say to the Manoli family who is here, to Anita, to CJ, to Ann, to Gerard and you and Joni, that we mourn your loss. We share in your loss. We find comfort in those memories that we have, the memories that will never leave us, and the love and respect that we have for Chuck remains, as does the friendship that we enjoy with each of you. So we thank you for being here tonight, and we love you. Thank you. Thanks. So on behalf of that scholarship committee, I want to express our appreciation also to the School of Humanities and Fine Arts, who host this Manoli lecture each and every year. And it is a great thing that they do. So please join me in extending thanks also to Father Rene, to Marcia, and to all the staff who make this event possible. Thank you. And now to introduce our speaker, the 4th annual Manoli Lecture. It's my honor to welcome to the podium the distinguished Professor Emeritus of Economics from the McKenna School, Dr. Peter Hutchinson.
Thank you, Mike. It's my pleasure, indeed my honor, to introduce tonight's speaker, Dr. Donald J. Mullineaux. An honor because Chuck Manoli was not only my professor, but he was also a friend and a mentor throughout my professional career, especially during those times since 1997, when I was fortunate enough to return to the campus at St. Vincent College. It's a pleasure because Don Mullineaux is a friend of over 50 years. Don is a 1963 graduate of the former St. Vincent Prep School, where he was a classmate of our own Archabbot Douglas Nowicki. And he's also a 1967 graduate of the college at St. Vincent. I've known Don since I first entered SVC as a member of the class of 1968. Mike, at our dinner earlier, referred to us as the infamous class of 1968. I take issue with that. I believe it is the famous class of 1968, but we won't get into that at this point. I've known Don since I first entered SVC as a member of the class of 68, and I became acquainted with him as a freshman because he was a running buddy with my older brother, John. We also had some spirited encounters on the intramural basketball courts, as Don played for a pretty good club called the Supremes, who came out of Jerry 1, and I played on a team from Jerry 2. As I recall, the championship game in Don's senior year held at center court in what is was then known as Kennedy Hall, and which to all of us will probably still be Kennedy Hall, it resulted in a 1-point victory for another Jerry 2 squad. Okay, but that's a story for another time, Don. When I switched my academic major to economics following my sophomore year, I obtained a better understanding of Don's academic reputation on campus. Because he was a year ahead of me and because I had switched majors rather late, we never had classes together. But we underclassmen knew about Don, that he was the star economics major in his class. Now, there's a story told about Don that may be apocryphal, but which I find rather fascinating. The story goes that Don planned to attend law school following a graduation. But Father Armand Jean Baldwin, then chair of the Department of Economics and Political Science, would have none of it. It is reported that he had told Don in no uncertain terms that he would be attending graduate school and earning a doctorate in economics. Now, apparently the Benedictines were a bit more directive in their academic advising in those days, Brother Norman. Now, whether this story is true or not, it's believable for those who knew Father Armand. Don received a graduate assistantship to enter the PhD program in economics at Boston College in the fall of 1967. He was well prepared for graduate school by the courses he took here at St. Vincent from Father Armand, from Father Callistus Milan, and from Dr. Andy Verzilli, himself a Bearcat who had recently earned his PhD from BC. The rest, as they say, is history. Following completion of his doctorate, Don joined the staff at the Federal Reserve Bank of Philadelphia, where he was later appointed as the Senior Vice President and Director of Research from 1979 to 1984. At that point, Don joined the faculty of the Gatton College of Business and Economics at the University of Kentucky, where he held the position as the DuPont Endowed Chair in Banking and Financial Services. Don retired from that position 2 years ago, but he is certainly not retired. He continues to serve as the chairman of the board of the Federal Home Loan Bank Board in Cincinnati, which is responsible for providing member financial institutions with a reliable source of funding for housing finance, community lending, and asset liability management within a 3-state area in the Mid-South. Along the way, Don has not forgotten his alma mater, nor has it forgotten him. He was named a distinguished alumnus of the college in 1995, and he has served on the advisory council of the college's McKenna School of Business, Economics, and Government. As the author of numerous scholarly journal articles, and having served as a consultant to a number of commercial banks, investment banks, trade associations, and government agencies, Don is well qualified to present this evening's lecture entitled Looking at 19th Century Banking Through a Manoli-Inspired Lens. It is indeed my pleasure to present one of St. Vincent's own, Professor Don Mullineaux.
Well, I should put to rest that the story is true about Father Armand. He told me there were way too many attorneys in the world back in 1966. Well, I'm delighted to be back here at St. Vincent for what is actually my second invited lecture on campus. Roughly 2 decades ago, at the invitation of Gary Quinlivan, the dean of the McKenna School, I gave a talk entitled, Is Bill Gates Right? Is Banking a Dinosaur? Now, some of you, the ones with gray hair like mine, probably recall that around that time, Mr. Gates had been routinely criticizing banks for their failure to use technology to meet the needs of customers efficiently and inexpensively. He predicted that technology-savvy competitors would eventually poach business away from banks, and unless they awoke from their technological slumber, banks might well go the way of the dinosaur. Well, banks got the message. I doubt that even Bill Gates envisioned that today we would be using smartphones to pay for things and to take pictures of our checks so that they could be electronically transmitted to our banks. But despite getting that wake-up call, banks have suffered a sizable loss of market share to non-bank competitors that mobilize technology better than banks do and do not have the burden of substantial legacy costs in the form of an enormous branch network of branches, and that customers are increasingly reluctant to visit, even when the coffee and donuts are free. To see how this has played out, I'll throw out this quiz question. What company is currently the second largest originator of residential mortgages in the United States? I heard the right answer. The answer is Quicken Loans, a non-bank company founded in 1985 that last year originated $80 billion worth of loans in all 50 states. Quicken has no branches and conducts all of its business over the internet. These days when I ask bankers what's the number one thing that keeps them awake at night, the answer I inevitably hear is millennials. No doubt because they seem to have adopted the same view of banks that Bill Gates had some years ago. But I've talked enough about the current banking environment. My main purpose here is to honor the memory of my dear departed teacher, Chuck Manoli, by taking his favorite kind of perspective, that is an historical one. I am one of the lucky ones. I actually had the chance to have Chuck as a teacher both in the prep school and the college. So I spent quite a bit of time with him. And I was lucky enough to be at some of the salons that Rich Schulte was talking about at dinner. And I remember saying to Chuck one time, you know, I have this recurring dream in which I am always failing a test. And the test is a history test. And I said, why do you think it's a history test? And he said, I have no idea why it's a history test, but if I was the one that was failing you, you can rest assured that you deserved that grade. And that was sort of the core of Chuck. He spent a great deal of time talking about what it meant to be living in a just society. I recall his admonition that history was not just about what happened, but more importantly, about why it happened. And when I went off to Boston College to become an economist, I never thought that I would be engaged in historical research. But I met a fellow at my first job at the Federal Reserve Bank of Philadelphia who convinced me there was a lot to learn about economics by taking an historical perspective. And tonight I want to share some of the outcome of that research with you, as the title says, through a Manoli-Inspired lens. The theme of the talk is that history teaches us that the origins of our central bank, the Federal Reserve, can be found in the formation of what were called bank clearinghouses in the first half of the 19th century. In fact, the rest of this lecture is based on a paper that I wrote with my colleague Gary Gorton, who's a professor of finance at Yale University. The title of the paper was called The Joint Production of Confidence, Endogenous Regulation in 19th Century Bank Clearinghouses. So if you have read that paper, you do not need to attend the rest of the lecture. But I'm going to assume you probably have not. It is the case that Americans increasingly rely less and less today on using an old-fashioned device called currency to pay for things. And at least one well-respected economist has called upon the Federal Reserve to abolish currency. But the currency we use today is very different from what people held in their wallets and handbags in the days prior to the Civil War. Today, one piece of currency looks much like another, save for its denomination, the picture of the person on the bill. All currency in circulation is a liability of the Federal Reserve, which means you can take it to your local Federal Reserve Bank and ask them to redeem it. Professors of money and banking like to joke that if you did such a thing, what you would get back for a $20 bill is two $10 bills. Because as everyone knows, our money is backed by nothing but the confidence we may or may not have in it. But in the early decades of the 1800s, banks actually designed and produced their own currencies which were called banknotes. Banknotes were of different sizes, different shapes, different colors, but each contained the name of the issuing bank and the signature of the bank's president. There were as many different currencies as there were different banks. Banknotes were the primary way that people paid for things in those days, and banks also made loans by dispensing banknotes to the borrowers. But importantly, all banknotes contained the promise that any holder of that note could carry it back to the bank and redeem it in an equivalent amount of gold. The basic idea was very simple. If banks had to always stand ready to redeem currency in gold, each of them would be limited in the amount of notes they could issue by the size of its gold holdings. In essence, this gold redemption requirement was the core bank regulation in its day. There were no federal bank regulatory agencies, and most state governments failed to regulate banks very heavily. Economic historians call this period the free banking period, since it was relatively easy to enter the banking business, and save for the gold redemption requirement, banking was largely an unregulated business. Some states did require banks to get permission to enter the banking business by applying for a charter, but the majority did not. There were no federal banks at the time, thanks to a successful effort by President Andrew Jackson to kill off the Second Bank of the United States in the early 1930s. Now, you don't need to be a sophisticated economist to recognize that banknotes were valuable assets, since they were, in theory at least, equivalent to gold and could be used to pay for things. But bank customers quickly came to recognize that their notes did not necessarily have a fixed value. While they could never go up in value, meaning you could never get more than $1 of gold for $1 of notes, you could very well get less. In the jargon of economics, banknotes could trade at a discount from par. A secondary market formed in these notes, mediated by brokers, where you might exchange notes issued by, say, the Bank of Latrobe for notes issued by the Connellsville Bank and Trust. And much like today, you can exchange dollars for euros or for British pounds. And the broker strategy was the old standby, buy low and sell high. So if a broker paid $9 to buy a $10 note in Greensburg that was issued by a Pittsburgh bank and then took it to Pittsburgh, he could collect $10 in gold, and that would earn him a profit of roughly 10%. The prevailing prices for the various kinds of banknotes issued by banks were published periodically in documents called banknote detectors or banknote reporters, one of which, the Van Court Note Reporter, was the forerunner of a daily newspaper that still is published today, called The American Banker. Now, economists have hand-collected data from these documents and analyzed the factors that influence the prices of banknotes. And one key factor was the distance from the issuing bank. Notes issued by the Bank of Altoona typically traded at or very close to par, meaning 1-to-1, for notes issued by other banks in the same town. But the price of a note issued by the Bank of Harrisburg might sell for 95 cents on $1. Well, why was that? Because to redeem the note for gold, I would need to transport it from Altoona to Harrisburg. And in those days, that was a somewhat costly venture. And evidence clearly shows that the discount a merchant or a broker would require increased with the distance to the issuing bank. Another key factor behind discounts from par was the prospect that a note was a counterfeit. And the bank note reporters I mentioned contained information about known counterfeit banknotes. And still another critical issue was the prospect that the issuing bank might fail to live up to the promise to redeem notes at par in gold. There's evidence indicating that notes issued by riskier banks would trade at larger discounts than notes issued by very safe banks. But the technology for measuring risk in those days was quite primitive relative to what we use today. Nonetheless, economists have little doubt that the broker-conducted secondary market in banknotes, supplemented by the publications revealing the prices of the notes, conveyed valuable information to note holders. Banks with notes trading at large discounts were either located in far distant places, were victims of substantial counterfeiting, or were suspected of over-issuing notes relative to their ability to redeem them in gold. The notes of what we might call good banks would trade at prices at or close to par, while the notes issued by bad banks would trade at substantial discounts, in some cases as large as 30 to 50%. Well, you might be wondering, why don't we see banks issuing their own notes today? The main factor accounting for the demise of these notes was a much-studied historical event called the Civil War. The Union aggressively issued bonds to finance the war effort, but fell far short of the funds that were needed. So the next step was to create a system of federally chartered national banks that issued what were called federal or national bank notes. And to assure that state bank notes did not compete with this new currency, the federal government put a tax of 10% on outstanding state bank notes and eventually increased the rate of taxation to 20%. In effect, state banks' notes were taxed out of existence. You might think this would mean that state banks themselves would disappear, since issuing notes was the primary way a bank attracted funds from individuals and from businesses. But as of this year, there are roughly 6,000 bank and thrift institutions in the United States, and a bit over 4,500 of them are chartered by their home states. So how did state banks survive the application of an exorbitant tax on what had been their main source of funds? The answer is they created another method of attracting funds by offering a new product called a demand deposit. To put it differently, these banks began to offer their customers checking accounts. Think of this as an example of technological change at work in banking in the early 19th century. But this new product was a mixed blessing, since it eventually became clear that it possessed characteristics that were likely to make the banking system more prone to panics. One of the main components of a banking panic is the so-called run on the bank, which has been frequently depicted in movies, most notably in Frank Capra's classic film, It's a Wonderful Life. In a bank run, most, if not all, of the bank's customers flock to the bank to withdraw their funds, because your place in line is the main determinant of whether you get your money back or not. Everyone tries to get at the front of the line, explaining the use of the term run. But no bank maintains the financial wherewithal to redeem all of its deposits, primarily because most of the funds deposited have been used to make loans. Consequently, the most common outcome of a run on any bank is the relatively quick failure of that institution, leaving some portion of the depositors, those in the back of the line, with a complete loss of their money. A few states offered insurance against this prospect, but the typical outcome of any major panic was that the insurance fund itself would fail along with the banks. So let's spend a few minutes considering a key distinction between banknotes and demand deposits. Banknotes represent a claim by the holder of the note on the bank's resources, mainly on its holdings of gold. Demand deposits, however, represent what I would call a dual claim. The deposit holder has a claim on the bank, since deposits can also be redeemed in gold at the discretion of the account holder. But the recipient of a check drawn on a bank also has a claim on the party who wrote that check. A merchant who is handed a check must consider first whether the check writer has sufficient funds in the account to collect the claim, and then second, whether the check writer's bank has a sufficient amount of gold to satisfy a redemption claim. The identity of a buyer doesn't matter when she uses banknotes, but it's quite relevant when a check is the medium of payment, for the simple reason that, to use popular parlance, the check can bounce. These dual sources of risk on demand deposits have a strong implication. They make it impossible for a secondary market to form in demand deposit claims, as it had done for banknotes. Because in order to set a price on demand deposit claims, brokers would need not only information about the issuing bank, but also information about each individual who holds an account at the bank. But it would be prohibitively expensive, at least in those days, to collect information on the risk that each bank customer might overdraw his or her account. So there was no secondary market in bank claims. And this meant that the information dissemination benefits that prices convey were no longer available. So while the secondary market would tell bank customers if their $100 note was worth less than $100, they were unable to know if the same might be true of their $100 deposit, because there was no such market. Instead, if a merchant decided to accept a check, it had to be at a fixed exchange rate of 1-to-1. Today's economists would be quick to recognize the problem with a fixed exchange rate of 1-to-1. It allowed banks to engage in riskier behavior because there was no secondary market price that would reveal it. And as deposits came increasingly to dominate notes on bank balance sheets, this missing secondary market in deposits grew much more relevant. And it soon became clear that some mechanism needed to be developed that would prevent banks from taking on excessive risk, or a lack of confidence on the part of the depositors would make the banking system increasingly prone to runs and to panics. So one potential solution to this type of problem, as economists would be very quick to note, is regulation. Rules could be put in place that would be designed to prevent banks from taking excessive risks. And of course, in today's world, we have many such rules. But during this period of our economic history, there was no central bank, there was no Federal Deposit Insurance Agency, or any state offices engaged in significant bank supervision. But economic theory and banking history also tell us that government need not be the sole provider of regulation. In an industry like banking, where the behavior by the Bank of New Kensington could end up causing problems for the Farmers Bank of Vandergrift and other nearby institutions, the affected banks have a strong incentive to take collective action to prevent bad behavior. But why should the actions of one bank have negative consequences on other banks? To use some jargon that would not have been employed in the 19th century, the problem was a lack of transparency. All banks promised their customers they could and would stand always ready to redeem notes and deposits in gold. But that promise is credible only when the bank has a sufficient stock of gold in its vault to pay off when customers decide to redeem. But there was very little information available about how much gold banks actually owned and how many bank notes or deposits had actually been issued against that gold stock. Economists call this a problem of information asymmetry. Consequently, when any one bank defaulted on its redemption promise, the customers of other banks would have good cause to begin to worry about whether their financial institution was suffering from similar problems. And the best way to find out if your bank can give you gold for your notes or deposits is to actually show up at the bank and make that request. But again, if all the customers show up en masse, to redeem for gold, such a run on the bank would cause it to fail, and multiple runs on banks would cause a financial panic. During the 19th century, such panics were unfortunately frequent occasions, as were the attendant economic depressions. At the heart of the problem lies something an economist calls an externality, meaning that the actions of one party can have negative effects on third parties. Think of pollution as an excellent example of an externality. But the externality that plagued the banking industry might have been resolved if information about the quality of every individual bank's balance sheet was free, credible, and widely disseminated. But computers and the internet had yet to be invented, and information was published sporadically and inconsistently. As I have already mentioned, fluctuations in the price of banknotes could send signals about the financial status of the note-issuing banks, but by the time of the Civil War, deposits on balance sheets had largely replaced banknotes. Deposit prices conveyed no information about the issuing bank, since the price was fixed at 1-to-1. But perhaps banks themselves could create a process or a mechanism that would substitute for the missing market and keep a lid on excessive risk-taking by the majority, if not all, of the banks. If so, we could think of such an outcome as a kind of self-regulation by the industry members. In a bit of historical irony, the mechanism that allowed for such an outcome was also brought about by the advent of demand deposit. If Archbishop Douglas writes a check to pay for a football that he plans to give to Pope Francis, the seller of the ball needs to collect payment. This means the check has to be transported back to the abbot's bank, which in the days prior to electronic communication was a costly and slow-moving process. Banks quickly came to realize that a lot of money could be saved if they all agreed to meet every day at a central location and handed over the checks to be collected from other banks and accepted checks drawn on their own institution. If there were 10 banks in town, this eliminated the cost associated with separate travel to 9 different locations and required a trip to only one. You don't need a degree in economics to recognize that a 90% saving can be quite motivating. The organizations that were established for the simple purposes of exchanging checks drawn on demand deposit accounts were called commercial bank clearinghouses. They still exist today. Like any organization, to be efficient and effective, the clearinghouse needed a strong governance structure and an established set of rules to guide behavior. The boards of directors of the clearinghouse were the senior executives of its participating banks. And the initial rules were quite simple, involving things like where to meet and at what time of day. These clearinghouses were formed in all the major cities during the 1850s, and they were potential sources of information about the financial conditions of the bank members. Indeed, they published either weekly or monthly balance sheets on the individual member banks. The key problem, you'll recall, is that the exchange rate to convert deposits into currency or gold is fixed at 1-to-1. And this created an incentive for banks to use deposits to make higher yielding but riskier loans with the deposits. Depositors would, of course, like to know if their bank's decisions are adversely affecting the value of their deposits, but they have no cost-effective way to determine if this is what is going on. Customers would clearly gain if some form of credible supervisor monitored the quality of each bank's deposits and disseminated the relevant information. Such a supervisor would need enforcement powers, lest it simply be ignored when calling an offending bank on the carpet for taking and excessive risks. As I've already said, bad actions by one bank can have negative effects on other banks in the same market, and the clearinghouses were well positioned to provide supervision of its members that could address these problems. In my research, I had the opportunity to study the constitution of the New York Clearinghouse, which was founded in 1854. And what I saw in the document were certain activities and requirements similar to those employed by colleges and universities. The clearinghouse required, for example, that member institutions pass an admissions test, that they pay an admissions fee, and that they submit to periodic exams by agents of the clearinghouse. Today we would call such exams bank audits. Members who failed to satisfy the clearinghouse rules and regulations were subject to disciplinary actions, including monetary fines, and for extreme violations, they could be expelled from the group. Expulsion from the clearinghouse was a clear negative signal concerning the quality of the bank's deposit liabilities. It suggested the probability that the expelled bank could exchange gold for deposits at the mandated exchange rate was uncomfortably low. And the clearinghouse had the ability to audit the books of any of its members at any time, which provided a strong incentive for member banks to behave prudently and also made any signals sent by the clearinghouse itself very credible. Some clearinghouses established reserve requirements against deposits. In 1858, the New York Clearinghouse required its members to hold 20% of its deposit liabilities in gold coins at all times. The Philadelphia Clearinghouse soon followed with a similar requirements. Other clearinghouses placed limits on the interest rates that member banks could offer on deposits. All of these actions are regulatory-like in nature. Indeed, when formal bank regulation was put in place in the 20th century, many of the same regulations were employed by entities such as the Federal Reserve and the FDIC. By supervising the actions of its members, the clearinghouse was attempting to assure that banks behaved prudently and avoided the excessive issue of loans and deposits. And if they succeeded at this mission, all banks would prove always ready and able to exchange gold for deposits when customers wanted to exercise that option. Now, while the actions of the clearinghouse made it more difficult for banks to engage in cheating on their customers by over-issuing loans and deposits, they could not eliminate the incentive to misbehave. So bank customers still had some incentive to monitor the behavior of their own banks. As I mentioned earlier, the most cost-effective way for customers to monitor was to go to the bank and seek redemption for gold. Individual banks often coped with runs that could be associated with this by simply suspending the right to convert, at least for a temporary period. And the bank would then contact its loan customers and ask them to pay off their loans immediately. This was clearly a recipe for making both depositors and loan clients very unhappy. The clearinghouse consequently needed to develop a strategy for promoting confidence in the banks, which, if it were successful, would diminish the likelihood a bank run would occur in the first place. The basic problem is that it's quite difficult for a bank customer to know the value of the assets the bank holds that, in effect, are underpinning the value of the deposits. That problem is particularly acute during periods of economic recession, since there will be defaults on some portion of every bank's loans during an economic downturn. Researchers who study banking panics have spilled a lot of ink over the Panic of 1857, which was quite a bad one. There were a number of precipitating events behind this episode, including the bursting of a bubble in railroad stocks, the sinking of a ship carrying 30,000 pounds of gold, in a hurricane off the Carolina coast, and the failure of the Ohio Life Insurance and Trust Company, which, despite its name, was one of the larger banking firms in the United States, with sizable operations in New York City. The cause of its failure was soon identified as fraudulent behavior by the management. The response by the New York Clearinghouse to the emerging panic in 1857 was to create a brand new kind of security called a clearinghouse loan certificate. As the label suggests, this new security was a loan made by the clearinghouse itself to one or more of its member institutions. These loans typically had maturities of 1 to 3 months, interest rates of 5 to 7%, and required the borrowing members to provide collateral, typically in the form of loans, to be eligible to borrow. There were 2 key elements to this innovation. First, the loan certificates were claims on the clearinghouse itself, which meant that they were a joint liability of all the members of the clearinghouse. Economists would call this a co-insurance arrangement. If a member with outstanding loan certificates failed, the remaining members shared in any loss in excess of the pledged collateral. And secondly, the loan certificates were acceptable in the check clearing process in place of gold or in place of currency, and that freed up these assets for payments to depositors making claims on the bank. During a panic, the clearinghouse effectively transformed itself from a collective of banks into a single firm-like entity. Accordingly, the clearinghouse would stop publishing the financial statements of each individual bank during the panic, but instead would provide relevant information about the aggregate of all the banks in the clearinghouse. While this prevented the identification of the weaker banks, it was also the relevant set of information, since all the banks were collectively responsible for paying off the certificates. The clearinghouse did not publish the names of the banks borrowing through the loan certificate mechanism, and the clearinghouse also decided whether its member banks could suspend the exchange of deposits for gold or currency. Most importantly, the clearinghouse decided the dollar volume of loan certificates that would be issued. During several post-Civil War panics, clearinghouses issued loan certificates in small denomination amounts, and banks began to provide these loan certificates to depositors seeking to withdraw. In effect, the loan certificates became a form of substitute currency that was available only during a banking panic. Depositors were willing to accept the certificates in lieu of currency because they held a claim against the collective of all the banks in the clearinghouse. This provided depositors a type of insurance against the failure of any single member. While there remained the risk that the clearinghouse itself could fail, the good news is that such an outcome never came to pass. And once the banking panic ended, the clearinghouse sought prompt repayment of outstanding loan certificates, returned the collateral that it held, and reverted to its more limited form of organization. If the clearinghouse had failed to take such actions, it would have provided banks with an incentive to make high-risk loans following the panic, since the risk of default would be assumed and shared by all the member banks and not just by the bank extending the loans. Students who are getting an A in their economics classes will recognize this as a kind of moral hazard problem. Now, I suspect I've told you more than you wanted to know about 19th century banking panics and the extensive efforts to deal with them. So perhaps it's a good time to step back and ask a question that I suspect Chuck Manoli surely would have asked if only we all had the good fortune of having him here. And that question is, what lessons do we learn from this historical examination of some episodes of 19th century banking. I think one lesson we learn is about markets. Since the days of Adam Smith, economists have taught us that markets typically are effective and efficient mechanisms for allocating resources of all kinds. This works in large part because the prices established in markets act as signals to buyers and sellers. Rising prices signal the prospect of shortages in the market, while falling prices communicate an overabundance of the good in question. So when the price of the banknotes produced by the Johnstown Bank and Trust were falling, the message was the bank might well be overproducing currency. Savvy holders of the notes would quickly try to redeem them for gold, with two possible outcomes, one good and one bad. The good outcome would be the bank would cut back on its production of notes, and note prices would eventually rise close to par. The bad result would be that extensive efforts to redeem, what we called earlier a bank run, could cause the bank to fail, imposing large losses on note holders. The second lesson is that the technological innovation that created a new banking product called a demand deposit had a dark side. Since deposits could also be redeemed for gold, they were even more likely to be the proximate cause of bank runs, since there was no secondary market in deposits that could send signals about the behavior of the issuing banks. The third lesson from history is that the banking industry, by its very nature, is subject to crises and periodic periods of instability. Economic historians have identified 7 distinct episodes of banking panics during the 19th century, and in every case, bank customers lost confidence in the capacity of their banks to repay what they had borrowed by issuing notes and deposits. The actions of the clearinghouses during the panics that I have described to you represented an effort by the banks themselves to promote confidence by engaging in what we might call self-regulation. Unfortunately, these actions were taken only in certain local markets and were not uniformly applied in all cases. So economists and politicians eventually came to recognize lesson number 4, that the maintenance of confidence in banks at a national level almost surely required some form of government action. The first effort to create a federal government mechanism to prevent bank depositors from engaging in runs was the formation of a central bank. Motivated by the Panic of 1907, and after the usual bout of political wrangling in Washington, D.C., Congress passed and President Woodrow Wilson signed the Federal Reserve Act of 1913. And as I mentioned earlier, many of the so-called tools of monetary policy that have been used by the Fed since its inception are quite similar or identical to those initially used by the bank clearinghouses. And several historians have taken the view that the origins of the central bank can be found in the clearinghouse constitutions. The informed pundits of the day assured those who would listen in 1913 that the establishment of a central bank meant there would never be another banking panic in the United States. That prediction was falsified in less than 2 decades by the arrival of the Great Depression. President Roosevelt found a new strategy for preventing bank runs. 2 days after his inauguration, he simply closed all of the banks. In what I think is one of the best euphemisms I ever have heard, it's referred to as a period of a bank holiday. Wow. By the time the banks were reopened, the president had convinced the Federal Reserve to provide what today economists would call implicit insurance against default for all deposits. A few months later, the insurance became explicit when Congress established the Federal Deposit Insurance System as part of the Banking Act of 1933. There have been no nationwide bank runs since. Let me conclude by thanking the School of Humanities and Fine Arts and the Manoli Scholarship Committee and the Manoli family for granting me the honor and privilege of presenting this lecture. And thank you very much for attending.